Before we begin, remember that this video is for educational purposes only and isn't insurance advice. Always consult a licensed professional for your specific needs. Let's break down an insurance topic that affects almost everyone but few understand clearly. You've seen the videos claiming you can be your own banks and get stock market returns with zero risk. But is indexed universal life insurance a remarkable wealth builder or an expensive trap? Today, we're stripping away the marketing hype to show you how these policies actually work, where the hidden costs are, and if it's actually right for your family. Alright, let's start with the real-world problem. This is the part that helps you understand what is actually going on before you spend money. Many agents pitch IULs as a way to be your own banks by borrowing against your policy. While you can take loans against the cash value, it's not free money, you're often charged interest and the passing benefit is reduced by what you owe. The problem is that many people don't realize they're essentially borrowing their own collateral. Always ask for a loan illustration to see how interest rates could impact your future balance. The biggest selling point is the floor, meaning if the market drops 20%, your account stays at 0%. This sounds amazing, but zero doesn't account for the monthly fees and insurance costs being deducted from your account. In a flat market year, you could actually lose money because the fees are still being charged even if you earn 0% interest. It's vital to look at the net return after all expenses are pulled out. You aren't actually invested in the stock market. The insurance company just uses an index to calculate your interest. This means you don't get dividends, which historically make up a huge chunk of total market returns. Furthermore, your gains are often limited by caps or participation rates set by the company. If the S&P 500 goes up 30%, but your cap is 10%, you only get 10%. You only get 10%. Now, let's look at why these policies can get expensive. Most people focus on the upside, but the internal costs are what usually sink a policy. In an IUL, the cost of the actual insurance coverage increases every single year as you get older. In your 40s, this might be cheap, but by your 70s or 80s, the cost can skyrocket. If your cash value isn't growing fast enough to cover these rising costs, the policy will start eating itself. This is why many older policies lapse just when the family needs the passing benefit most. Before a single dollar of your premium goes toward your cash value, the insurance company takes a cut. This is often called a premium load, and it can be as high as 5% to 10% of every payment you make. On top of that, there are monthly administrative fees that remain for the life of the policy. These fees are much higher than what you would pay in a standard brokerage account or a low-cost term policy. If you change your mind and want to cancel your policy in the first 10 to 15 years, you'll likely face a massive surrender charge. This fee can eat up almost all of your accumulated cash value if you try to walk away early. This makes the IUL an extremely illiquid asset during the first decade. Always check the surrender value column on your illustration, not just the account value. Quick reminder, this isn't personal advice. Policy terms and rates vary, so always compare and consult a licensed agent. This is the part many agents don't explain well: what happens when things go wrong late in life. If you've taken large loans against your policy and the policy eventually lapses because costs got too high, those loans become taxable income. This is known as a tax bomb, because you could owe the IRS thousands of dollars on money you already spent. This often happens to seniors who can no longer afford the rising premiums. Keeping the policy in force until passing is the only way to avoid this tax hit. When you borrow money from your policy, the interest rate the company charges you is usually variable. If interest rates in the economy go up, the cost of your policy loan can increase significantly. If your policy's internal growth doesn't keep up with the loan's interest rate, your debt will grow faster than your savings. This negative arbitrage is a primary reason why IULs fail in the long run. Insurance agents use illustrations to show you how much money you might have in 30 years, often assuming a steady 6% or 7% return. However, the market doesn't move in a straight line, and the company can change your caps at any time. An illustration is just a guess, not a guarantee. If the company lowers the cap to 5% next year, all those fancy projections from the sales meeting become useless. So, should you actually buy one? Let's look at the specific scenarios where this makes sense versus when it doesn't. For 90% of families, buying a cheap term life insurance policy and investing the difference in a low-cost index fund is a better mathematical move. You get the same protection for your family, but your investments aren't burdened by high insurance fees or surrender charges. You also get the full market return, including dividends. This strategy provides more flexibility and usually results in a higher net worth over 20 years. IULs are primarily designed for high net worth individuals who have already maxed out their 401ks and IRAs and are looking for a tax-advantaged place to put extra cash. They can also be useful for complex estate planning or business succession. If you aren't earning a very high income or haven't maxed out your other retirement accounts, the fees of an IUL will likely outweigh the tax benefits. Be wary of any agent who uses words like may, potentially, risk-free, or infinite banking without explaining the costs. If they won't show you the may potentially column of the illustration, which shows what happens if the market stays at 0%, that's a massive red flag. A good professional will be transparent about the fees and the possibility that the policy might require more money later in life to stay active. That's the practical version of what matters most. The big idea is to understand the problem, compare the right details, and avoid rushing into an expensive decision without context. If this helped, like and subscribe for more practical guides that help you compare costs, understand quotes, and choose the right insurance strategy with more confidence. If this saved you money, like the video and share it with someone who needs it. Thanks for watching. Remember, this is educational content only. Talk to a licensed insurance professional before making any coverage decisions. Subscribe for more plain English insurance guides.